Good morning. We're going to resume our class for today, the accounting equation, the second lesson of the topic, of the course. Now, you remember the second lesson, the equation is asset is equal to capital plus liability. Uh, Yesterday, we said that this equation has to balance. For every transaction, this equation has to remain balanced. So there's an example we did yesterday. Let me just recap. If this left side increase, the right side must also increase. If this left side decreases, the right side must also decrease. It must always be balanced. Now, let me give you an example. We said if you're buying a computer. Let me say you're buying a computer in cash. Let me say you're buying a computer in cash. What will happen is that cash is an asset, and therefore your asset will reduce. So this is asset, which is cash, it will go down. But again, computer, which is also an asset, will go up. Computer, which is an asset, will go up. So this is computer, it goes up, cash goes down. The net effect here is zero. And there's no effect on the right hand side. So the accounting equation is balanced. What about if we choose to buy the computer on credit? If we choose to buy the computer on credit, then now this is computer purchased on credit. So what will happen is that uh, your asset will go up. Your asset, which is computer, will go up. So this is computer has gone up. Computer has gone up, and your liability will go up because you bought a computer on credit. So you bought a computer on credit, which means you'll pay later. So your liability will go up also, which is, let me call it computer payable. Computer payable. So, so the left hand side has gone up and the right hand side has also gone up. The accounting equation is balanced. Now, I want to introduce expenses and revenue. Expenses and revenue. Now, revenue is the same as sales. Revenue is equal to sales. Revenue is equal to sales. Now, expenses are what we use to generate revenue. If you're selling computers, you buy the purchases, you sell these computers to generate revenue. If you're paying electricity in your business, so this electricity is an expense used to generate revenue. So let me give you an examples of expenses. Examples of expenses which are costs incurred to generate revenue, directly generate revenue. So I may have purchase of inventory, purchase of stock. I may have rent that I pay. I may have electricity that I pay. Yeah. I may have insurance that I pay for fire or for theft to protect me in case something happens. So expenses are costs we incur in order to generate revenue. In order to generate revenue. So this should be different from assets. Assets are things which are tangible mostly, do not all, which can be converted into cash, yeah, and which have future economic value. Future economic value. My pen is disappointing me. Future economic value. Now, how does expenses affect the accounting equation? You remember capital is the same as owner's equity or owner's investment. Now, let me say this. For every expense, your investment in the business is affected negatively. So remember this always. For every expense, for every expense, for every expense, capital is affected negatively. Your worth goes down. Your the value of the investment goes down for every expense. For every expense, the value of your worth, the value of your investment goes down. For every revenue, revenue or sales, owner's equity goes up. So this is expense and this is revenue. Okay. If you make sales, the worth of your business goes up. If you make expenses, the worth of your business goes down. For every individual expense, the value, the net worth of the business goes down. For every individual sale, the net worth of the business goes up. Okay. Now let us do an example. Let us do an example. Then we just call it a day. Okay. Now, suppose you pay for electricity expense of 10,000. Electricity expense of 10,000. Electricity, elect, let me just call it elect, 10,000. Okay. How will that affect the accounting equation? You pay in cash. If you pay in cash, your cash asset will go down. So this one, your cash down by 10,000. Okay. But again, expenses affect capital negatively. So your capital or your owner's equity will also go down by 10,000 through electricity expense. Electricity expense. Okay. So as you can see, the accounting equation is balanced. The left side has gone down, the right side has gone down. So it is right this way. Now, what about if you if you let me change this first. What about if you purchase inventory? You are selling computers. Let me say you are selling computers. In this case, uh, computers now, if you are selling computers, you are selling computers. Now, this is a unique case which I want you to understand very clearly. Computers, in this case, is not an asset. Computers, in this case, will be a purchase expense because the business that we're dealing with is a business that buys and sells computers. So it doesn't keep computers for future use. There's no element of future use. It is for immediate sale. So stuff that are bought for immediate sale, these are not now assets. These are purchase expenses. So for a business that is selling computers, when they buy a computer to sell, that is a purchase expense. Purchase expense. But if a school buys a computer for the accountant, that is an asset. If a bookshop buys a computer, that is an asset. If a hardware buys a computer, that is an asset. But if an electronics shop buys a computer, that is not an asset now. That is a purchase expense. So get the distinction very clearly. It confuses very many people. So when you buy a computer for resale or any stuff for resale, that is a purchase expense. So the key word here is for resale. If you buy anything for resale, that is a purchase expense, not an asset anymore. Even if in other situations it could be an asset. So let me give you an example. Toyota Kenya, when Baraton buys a vehicle, that will be an asset to Baraton. But when Toyota Kenya buys a vehicle for resale, that is a purchase expense. It is not an asset. Unless at the end of the year it is unsold, then it will be closing inventory, which we'll look at later on in the course. Now, let me say you're buying computers for resale, you're buying in cash. So this one, the purchase expense will make capital to go down or on as equity. So this is purchase expense. Purchase expense. So the right hand side has gone down. On this side, cash goes down. Cash as an asset because you bought computers for resale and you have paid cash. Okay. Now, what if before I give the next example, what you must notice here is that we specify why capital has gone down. We specify by saying purchase expense. We also specify by saying cash has made asset to go down. Purchase expense has made capital to go down. You specify, you don't just say capital has gone down and asset has gone down. You specify which account. Okay. Now, what about buying a computer on credit? What about buying a computer on credit? You buy a computer on credit from Safaricom or from S&S or from any other shop. Now, if you buy on credit, then it means you will pay later. Purchase on credit means you will pay later. So you have not paid. You've incurred the expense because it is a business for selling computers. So there's purchase expense, makes capital to go down, and the liability goes up because this is computer payable. You will pay later. Okay. So there's no effect on the left hand side. So this is 0. And the overall effect on the right hand side is also 0 because the decrease has been offset by the increase in liabilities. Your obligations have increased. Your investment in the business, the worth of the business has decreased by the purchase expense. So the net effect of the decrease and the increase is 0. So your accounting equation remains balanced. Okay. Now, what about sales? What about sales? What about sales? What about sales? Now, sales or revenue sales makes your worth to go up. Capital goes up through sales or revenue. Okay, so if it is if you sell stuff in cash, let me say you are a bookshop and you sell books worth 1,000, then sales will increase by 1,000, and if you receive cash will also increase and will make your left hand side to go up and the right hand side to go up because you've sold and you've received cash. So your cash has gone up, your equity, your owner's equity has also gone up. Okay. Now, what if you sell these books on credit, which means you have not received cash? If you remember the accrual concept is that revenues are recognized when they're earned, not when cash is received. So you will not wait until you receive cash to recognize this in your books. Revenues are recognized when they're earned, not when cash is received. So a transaction, it becomes a transaction immediately when the transaction is done, not when the cash is received. Now, when you sell on credit, then sales will make capital to go up, and also which asset will go up will be receivable or debtors. We used to call these debtors, but now we call them receivables. It is so easy to understand. Receivable, you're supposed to receive it later on, to receive cash later on. It is simpler to understand, not like debtors, creditors. Receivables, payables is easy to understand. So your left hand side has gone up, your right hand side has also gone up. Now to recap the lesson that you have had today, we were looking at the effect of revenue and expenses. on the accounting equation. Now, we have realized that revenue increases owner's equity. So revenue increases owner's equity. Expenses decrease owner's equity. Yeah, so if you are faced with any question or any situation like that, just know that revenue increases owner's equity and expenses reduce owner's equity. That marks the end of our lesson today. May you have a good day and may God bless you.